Hello again. Now, South Africans are in for another tough financial year. The Reserve Bank has once again hiked the repo rate. The Monetary Policy Committee decided to increase the repo rate by 25 basis points, taking the country's repurchase rate to 7.25%. Now, this means the prime lending rate is going to be 10.75%. That will be the rate at which your banks will be charging you for credit. Now, this increase is going to be taking effect from tomorrow, the 27th of January.
The MPC decided to increase the repurchase rate by 25 basis points to 7.25% per annum with effect from the 27th of January 2023. 3 members of the committee preferred the announced increase. 2 members preferred a 50 basis points increase. The revised repurchase rate remains supportive of credit demand in the near term, while raising rates to levels more consistent with the current view of inflation and risks to it.
To speak to us now on how this new repo rate that's higher is going to affect ordinary South Africans, I'm joined by economist Dr Elna Moolman from Standard Bank. Dr Moolman, good afternoon. So how will this now impact the ordinary consumer?
Good afternoon. Obviously, it will have a negative impact, and of course, this is just amplifying the pressure that we're already seeing from very high inflation in general, and specifically of non-discretionary spending items such as food and fuel. And of course, we're waiting for a steep electricity tariff increase as well. But the good news is that it was a smaller increment than what we saw throughout last year. And this might very well be getting very close to the peak in the interest rate cycle. And in terms of the year ahead, there is some relief for consumers expected from a moderation in inflation. And we assume that there will be ongoing job creation, even if it is still at a gradual pace.
Now, I mean, this is now taken the prime lending rate to above 10%, just under 11%, at 10.75. I mean, that's going to introduce a bit of more stress for consumers and those who are owing money, servicing their debt.
Absolutely. I think what is positive is that during this period of relatively low interest rates, which we knew were unsustainably low, consumers didn't go out on this borrowing spree. And in other words, generally speaking, their balance sheets are still in a reasonably healthy space. And so we're not overly concerned about the impact that this is going to have on their financial situation. So yes, it will be somewhat more negative than before. There will be a little bit more pressure. But generally speaking, fortunately, most consumers aren't overextended and should therefore be able to tolerate this, especially if we're right that there should, in due course, be some relief from lower inflation and possibly ongoing employment creation.
Yeah, that may be from the third quarter of the year, as the Reserve Bank governor said. But, I mean, this kind of an increase would slow credit demand?
It could very well slow it. I think the key factor, however, is going to be what happens on the employment front. We're very encouraged by firms signaling that they're a little bit more optimistic about employment. And of course, in the latest labor data, we just started seeing some positive improvements. Now, of course, there's a risk that electricity load shedding could derail that. But as a base case, we're saying the economy has been on a recovering trajectory since 2010, since that steep decline that we had at the beginning of the pandemic. And we haven't really seen a labor market recovery. So it would make sense for firms to just rehire the people that they retrenched in this period of the pandemic. And so should that continue, then the net impact should be reasonable for consumers. In other words, that would then make us even a little bit more optimistic about the outlook for credit and how much they can prudently take on from here.
Yeah, a big aspect that stood out for me, it came out from what the governor was saying, is the fact that this matter that you've just mentioned about load shedding has, in fact, in their outlook, shaved off 2% in terms of GDP growth. And their outlook is now 0.3%. So pretty much we've been robbed of a possible 2%, 2.3%, 2% gone because of load shedding.
Absolutely. It's very difficult to quantify that, of course. And I would say if there is any positivity coming out of this, then the silver lining is that we are seeing a lot of investment from the private sector into generation capacity. In other words, buying some generators, buying some battery, etc. And we expect more and more investment to take place. So the economy is a little bit more resilient towards this load shedding. But like you say, it is a very negative impact. It's very difficult to plan. And it intensified, very abruptly and far more than we expected.
Yeah, and of course, inflation still remaining above that target range of between 3 and 6%. I think the midpoint is about 4.5%. Now, from a consumer perspective, what would you be advising your clients as a bank to be doing now with these new higher interest rates? What would be the wise thing to do?
I think that in any generally uncertain circumstances, it is always best to just be very cautious in your financial management. In other words, we'd be quite cautious given all of these uncertainties. We've already mentioned the possibility that growth could be extremely weak. And then inflation is not only already quite high, but all of this load shedding and the additional cost for businesses may be passed on to consumers. And so it would be quite pragmatic to factor in the potential that the economy could be doing still reasonably poorly in the year ahead and position oneself accordingly. Like I said earlier, we're quite encouraged by consumers generally being responsible over the last year or two, despite a period during which interest rates were very low.
Recession? Could we have a recession this year?
It's not our base case forecast, so we're a little bit more optimistic about growth than the Reserve Bank, and it's mainly because of two factors. One is that we think that we're going to see large-scale private sector investment into electricity generation. In other words, we've seen the relaxation of regulations, and we think that the private sector is really now investing on the back of that. So that should boost growth a little bit. And then secondly, we think that there's already significant private sector generation in the economy. And so firms are able to tolerate some of this load shedding that we're seeing. It's still very negative, but perhaps not quite as dire as the SARB's forecasts would suggest.